Just wanted to, by the way, I just went ahead and started the recording. James, can you reshare the presentation? We're joined by our Senior Associate, James Hoth, who is assisting us with the technical side of things. Awesome, thank you so much. So my name is Jacob Robinson. I'm an experienced Senior Associate here at BDO. I work in the forensics practice, specifically in our data forensics group. So what that means is we're really the data analytics arm. We assist with a lot of analytics surrounding large structured data sets. My personal experience is about 5 years worth of experience, both in professional services at BDO, as well as some time spent in industry. So I worked on the operational analytics side of things, as well as the fraud analytics side of things. I have a lot of different types of experience, similar to kind of Brian. Obviously not nearly as long, but I've worked a lot with the antitrust litigation space, focusing on communications between members of joint defense groups, as well as other cases surrounding export compliance, payments fraud, and asset misappropriation. So I've got a couple different types of experience, and I'm looking forward to talking about the different tools and methodologies that we use in our day-to-day, and the expanding field, especially as analytics is applied to compliance and fraud. So from there, I think we can hop over to the next slide. So quick agenda for today. Going to walk through a little bit about why we're here talking about fraud, some of the big hitters about how fraud is showing up in society and all of the different things that are evaluated. Then walk through fraud and forensics, so an overview of forensic accounting and fraud itself. We'll talk some analytics, tools, applications, and things like that. And then we'll move into analytics in action, really the financial statement fraud and asset misappropriation, so things that are going to be near and dear to everyone here's hearts. And then finally, we've got some case studies at the end if we've got some time to kind of walk through other big things you might hear in the news. James, I think good to go.
Great. Why don't we start out with some regulatory updates, right? These are direct fraud news coming out of both the SEC and the DOJ. And I think it's really important to kind of start out with a slide by this, just to highlight the importance of forensic accountants and the fraud industry as a whole, and look at some of what's happened based on recent publishments from both the SEC and the DOJ. I won't read through all the details in here, but there are a couple, I think, important highlights that as an audience member, everybody I think would have appreciation for, because fraud and forensic accounting can apply to any industry, and it can apply to folks at any level within their careers. That's all the way up from the senior management and board down to first year associates or even interns. Well, some of the thoughts and concerns that the board has when it comes to fraud or anti-fraud in the compliance program might be different than somebody in an internal audit department or even a new hire. It's important that everybody kind of has a fundamental understanding of the importance of really combating fraud in society. So starting with the SEC, coming out, these are all, everything on your screen right here, just 2023 statistics coming out of last year. Over 784 enforcement actions with over $5 billion in financial remedies, and nearly $1 billion to harmed investors, right? These are really big numbers in terms of the number of actions and the dollars in play. And again, this is just what was resolved last year in 2023. A couple important highlights to also mention in the SEC, kind of this top part of the section, is the commission received more than 18,000 whistleblower tips in fiscal year 2023 alone, right? That you can just imagine the numbers that are being presented here, and the staff in your regulatory bodies that are in charge of investigating it. It's really, you can see that 18,000 tips, that's not something anybody can get through in a given year. And it's really why it's important that companies have processes in place to really combat or have anti-fraud, or have anti-fraud provisions. Moving down a little bit more to some other SEC highlights, right? kind of a little bit more relevant to maybe this audience here on the phone, right? The SEC charged 5 unregistered brokers and 4 companies and widespread pre-IPO fraud schemes. Again, it's important. We'll go into that in more detail later on this call. But pre-IPO readiness, right? What are some of the tools? What are some of the risks that you can leverage in your every day-to-day process to really try to combat fraud? And then we're looking at the right-hand side, looking at some statistics directly from the DOJ. 240 individuals charged last year, 226 of those, 226 convictions last year. And then you've just got some other statistics about executives, lawyers, and medical practice individuals that were charged. Why is this top chart important on the DOJ? That your regulators are not only are not focused solely on corporations, they're also focused on the individuals involved in these frauds and really holding them accountable for the actions that are made. And then down at the bottom, corporate resolutions. This is really, getting into just some statistics directly from the DOJ fraud section for the convictions and resolutions in 2023 alone. You see only 8, maybe some of you read that as only 8 corporate resolutions, right? You got to appreciate that many times when the DOJ and the SEC are investigating fraud or forensic accounting related matters, these are multi-year investigations, and it takes many times cross-border collaboration, something that we're seeing a lot more from the regulators to really get at the issues and then investigate those issues and then come to a corporate resolution. So these are just some quick statistics coming straight from your regulators. And again, one point that I brought up, we won't necessarily go into details later in this call, but it's, you're seeing a lot of the regulators as they show up at conferences and speak about kind of their initiatives and looking forward, thinking into the future. You really hear a lot on cross-border collaboration. So that while we've got, on the screen statistics from the DOJ and the SEC, they're working and improving the way they work with their counterparts in other countries. And you're seeing that in a lot of the resolutions that are coming out with these corporations. With that, I think we can transition on to the next slide. And then bringing this into the 2022 ACFE report to the nations, right? So the ACFE, or the Association of Certified Fraud Examiners, put out a report in 2022 with just some statistics that I thought this group would find interesting. Again, as we set the foundation for the later focus of this presentation, right? You got the highest median loss industries, real estate, probably a top an industry that's very relevant to many folks on this call, but utilities, wholesale trade, construction. The point, you're seeing some big numbers on the screen in terms of median losses, but what's important is also kind of what was mentioned earlier. This can impact fraud, can impact any industry in any role. In the top hand right, have some statistics about how half of all reported frauds occurred in which departments, right? So you're seeing kind of a mixture between operations, accounting, executive upper management, and sales to make up that half. Anti-fraud controls, it's really important, a piece that we'll get into later in this, right? You see the FE is pointing to having controls in place, in fact, lowers or reduces the risk of fraud and also allows for quicker fraud prevention, right? At the end of the day, more controls in place. You have to balance, right? What can your company afford in terms of, budget for anti-fraud related controls? And that's where, maybe it's there are some manual processes that you have to put in place, as opposed to automated processes to combat fraud. But what's important is that everybody kind of has that in the back of their mind, and you're thinking about that as you work through your everyday processes. And then what I thought was interesting is this bottom right statistic. A typical fraud case lasts about 12 months before detection, with a median loss just over $100,000. So again, what's the important takeaway from this slide, right? It's really we're kind of setting the foundation for some of these anti-fraud provisions and forensic accounting activities, and then we'll get into later in this presentation kind of how these apply in more practice. James.
Yep. So from there, going to kind of go into a high level on fraud and forensics. So how we sit in a group and what kind of things we're going to be investigating and how that really relates back to CFA professionals. James, if we can go to the next slide. Awesome. So this is kind of a comparison of what most people think of when they hear accounting. Most people probably think traditional audit. So that's going to be not really where we sit. That's the group that usually comes in. They're trying to do the annual audit. They come in every, pretty cyclically. They're coming in and they're ultimately trying to prove fairness of financial statements and the accuracy for investors. So that way you can feel confident in what you're looking at and that everything makes sense. Usually through limited control testing, there's not going to be a full deep dive looking for evidence of fraud or actual potential illegal activity. Whereas for forensic accountants, we're going to come in for investigations specifically around questions that have been raised, concerns or gaps that have been identified. And we're going to be looking specifically for potential illegal financial activity. This usually means that we're going to be gathering evidence for a court of law. So a lot of what we do is making sure that our processes are repeatable, they're auditable, they make sense. They're very clear steps that were taken. And then ultimately, we conduct a lot of internal control testing. So this is going to be making sure that there are proper separations of duties. There's also going to be looking for instances where someone has complete oversight and control to execute an entire business process, and making sure, those are not really things that are happening. There's a distribution of abilities to get the business done. So ultimately, the big takeaway here is traditional audit is not intended to catch fraud, whereas forensic accounting is looking for specific illegal activity. You're not going to see financial statements coming out saying we think there's fraud happening here, but forensic accounting, we're going to come in when there's questions raised to try and assist with the fact finding. So what does a forensic accountant look like? Ultimately, we have a lot of varied experience. Not everyone is an accountant by trade. For example, Brian is an accountant by trade, but I went to Georgia Tech. I have an engineering degree and I focus on, data systems and things like that. We do have a lot of people, though, that are accountants, economics, finance backgrounds. We also have a lot of people with prior regulatory body or law enforcement experience. So they are coming from the actual prosecution side of things and looking for, improper activity. And as analytical programs are being built out and technology is being continued to roll out, we're seeing more and more statistics, engineering, database systems backgrounds. So our teams are very varied, and it's really becoming that way across the industry. There are a lot of different certifications that we have. There are CFAs that are on our team. We aren't just going to come in with CPAs. We have a lot of people that are also getting more crime-based certifications, such as the CFE, so the Certified Fraud Examiner, CAMS, which is focused on anti-money laundering, and the CFF, which is Certified in Financial Forensics. And then our analytics side, the more data-heavy people are focused on SQL, Python, R, other coding languages as they've really evolved in the last couple years. Ultimately, we work in two major types of projects: proactive and reactive. So those proactive projects are going to be focused on anomaly and pattern detection. They're usually a longer time frame. Think of a compliance program build out. That's really going to be what a proactive engagement looks like for us. The idea is looking for potential opportunities for fraud, or it's possible that fraud or something potentially fraudulent is already in place at a company. These are going to be a great opportunity to use analytics to build pattern identification and identify system gaps. And then our reactive projects are very targeted, very short term, often, depositions, court dates. We need to move quickly. We're trying to assist with confirming or disproving fraud claims and opportunities for remediation if there are those. And analytics is more powerful here in really making sure that sampling is done effectively to investigate the questions that are being raised. And then if there is a question or potential damages that comes out of it, we help with the quantifying and risk side of things there too.
Yeah, so moving into what is fraud, right? So there's two really focuses on this slide. Both of this information, you've got the fraud triangle on the left, right? What is the fraud triangle, right? These are the decisions that someone makes to essentially when they're committing fraud, right? So as part of that, they're looking, they make decisions that relate to financial pressures. There's an element of rationalization, and then there's also the opportunity, right? So when you bring financial pressures, rationalization, and opportunity together, right? That's essentially the perfect environment for fraud, and that's the mental process someone might take when they're involved in making a fraudulent type decision. Right. And so the opportunity is someone have an opportunity to actually do something in their everyday role, right? It's really gonna be difficult for someone to commit fraud if they don't have the opportunity. Maybe that's somebody in an upper management role where they have the opportunity to maybe manipulate the financial statements. It could also be someone in an accounts payable role or a sales or even a junior level role that has the opportunity to set up vendors and could set up a vendor that they're associated with to try to reroute payments. Rationalization, right? This is the mental process that someone goes through when they're making these decisions, right? This is maybe everybody's doing it. Maybe the person before me did it, right? Or no one's going to care, or this is just a little bit of money, right? These are all the ways that someone feels like it's okay that the decision they're making is not in fact improper. And then the financial pressures. The common example you see here is people living above their means, right? Maybe somebody living in a more expensive house. Maybe a spouse lost a job and they're now under financial pressures to make ends meet, right? When you bring all of these three together, right, that's what the fraud triangle is identifying. And then on the right hand side, what do you have is the fraud tree, right? How would this be useful to you in your everyday? The fraud tree is really a critical piece as part of brainstorming, right? So while we live every day in forensic accounting and fraud, and these are topics that regularly cross our desks in the engagements we work on, you might not be so often exposed to these topics, but the fraud tree is a great awareness tool and even a good decision making tool as you're maybe doing due diligence for a target company, or even due diligence on a potential investment, right? The fraud tree is broken up into three primary elements. That's corruption, asset misappropriation, and financial statement fraud. And we'll go into the details of each of these sections, or excuse me, we'll actually just go into the details of asset misappropriation and financial statement fraud later on in this slide. So I won't go, later on in this deck. So I won't go into too much detail, but on the other side, we're not going to speak a lot about corruption on today's call. It is a really important topic. We go back to the DOJ and the SEC. A lot of the enforcements and updates coming from them in a lot of the recent cases do involve corruption, and there could very well be corruption risk involved in the projects or the tasks that you're dealing with on a daily basis. And corruption is essentially comprised of examples such as illegal gratuities, bribes, and conflicts of interest. And I think with that, we'll transition into the next slide. Right, so now we're going to break those three elements of the fraud tree down. So as we discussed, asset misappropriation schemes. What are these? These are the most common, yet the least costly types of schemes to an organization. Right, these relate to activities such as vendor or customer invoicing schemes, expense reimbursement, maybe some different payroll schemes such as ghost employees, and also different schemes involving cash or checks and payments type processes. You can see on the right hand side, almost 86% of the cases involves asset misappropriation. Why is that? This is where most people, I shouldn't say most people, but a lot of when we go back to the fraud triangle of opportunity, a lot of people's role, especially as they move up in the organization, they have some opportunity or access into financials and related financial systems. And that's where, again, once they have the opportunity to get into those systems, they see a control gap or they see an opportunity, they rationalize it or they have pressures. And that's really where asset misappropriation schemes occur. While they're also the most common, you'll see, like we said, they're the least costly, right? That's a little bit slower in most instances, I should say. We've certainly seen the cases where asset misappropriation schemes are in fact quite costly. But most cases, this is your accounts payable manager, somebody in the Treasury Department at a small company, and they're rerouting or skimming out a couple $1,000s at a time. And again, we go back to some of the statistics directly from the ACFE that we covered in the beginning. A couple $1,000s over a 12-month time period, which is the average time before something is detected. And that's where those still are relatively lower cost impact than when you get into some of the other topics, such as financial statement fraud. Financial statement fraud, how it differs from asset misappropriation is this is the least common, though the most costly. Right. So this is where not everybody in their day-to-day role is really going to be in a position where they can impact the ultimate financials. Right. Someone in a junior reporting role has got to report to their manager, who then reports to the CFO. And, a lot of organizations have, various segregation of duties and lines of or chains of command that could prevent somebody from a lower level. But, financial statement fraud, this is essentially, a material misstatement or omission or, a disguising of certain facts on a company's financial statements. And then corruption, like we mentioned on the last slide. Corruption is kind of that middle aspect. A lot of times corruption also has touch points into asset misappropriation or financial statement fraud. But as we mentioned, bribery, kickbacks, conflicts of interest are the types of activities that occur within the corruption element of fraud. James? And then fraud detection, right? So I think I've kind of, gotten to this point on some of my earlier slides, but according to the ACFE, 42% of occupational fraud is detected through tips. You can see that on the right-hand chart at the top. If you actually look further down that chart, I believe it's the fifth one down, 5% is identified by accident. So you're talking almost 50% of occupational fraud between tips and by accident or how it's detected, right? So what does that mean to this group, right? The idea with data analytics, the idea with having forensic accounting teams has evolved as just traditional accountants to teams with math majors and statisticians and folks with a more engineering and technology-based backgrounds. Is that when you bring that together in a team, right, you're helping organizations put controls in place that can prevent and detect fraud earlier on in the process. And so you can essentially, in the future, an organization is a lot of organizations are striving to kind of reverse that 50% trend where more fraud is identified or detected from management review and from internal audit and other, kind of preventative mechanisms. And then we move into, well, what about when it's critical that a complaint or an allegation is received by proper personnel? So what if you did identify potential fraud or confirmed, improper activities within your day-to-day job? Then most companies have a process in place for how that should be reported up. Should you go directly to your manager? Should you go directly to senior manager? Should you go to the board? Most companies have a process in place and folks you can reach out to, but if not, there's a number of different considerations you have to take between compliance, legal, and an internal audit department, just depending on how your organization is set up. And then it's the next, kind of internal assessment point that you have to make is where within the organization did the potential fraud occur, and really wanting to kind of make sure that that's reported at least a step above the level that the potential fraud had been identified within. So I think a really important takeaway here, and this is a segue perfectly into Jacob in the data analytics piece is really reversing the trend on how occupational fraud is detected, and reducing the tips in by accident and increasing internal audit and other mechanisms for preventing and detecting fraud.
Awesome. So kind of going off of that, let's talk about, the 5 major parts of most businesses, and really the different kinds of fraud schemes that we see within those businesses, within those segments. So most businesses have some semblance of customers, management, employees, suppliers, and the board. And within each of these parts of a business, there's going to be a variety of different schemes that are unique to that part of the business. And we need to think about and we approach all of our investigations and projects based on what kind of scheme we're looking for, but we also know how to look for all of these different things. For the buy sell side of things and the investment side of things, really the place that you need to be most concerned will most likely be employees, management, and the board. And this is things questions that are going to get asked during the due diligence process when you're scoping an investment. You're going to be looking into these questions and you may not even realize that you're doing it. So a lot of the things that we look into, especially when it comes to the employee side, is off balance sheet behaviors, shell companies. Do you see that a company is continually increasing the number of subsidiaries while its liabilities are not proportionally increasing? Write-off schemes. These are going to be things that are going to be coming from the employee side of things. Management is where you're going to see financial statement fraud, because they're going to have, as Brian mentioned earlier, the opportunity to have those kinds of, influence over the business to affect the financial statements. There's other different, schemes that are going to be stuffed in with management. And then the other thing to think about is even the board. Do you see a business that is opening up a new business line and they are talking about, there's reporting going around about they might be acquiring, a small startup, and you see that the startup has a board member that is consistent with the board member at a company you're looking at. So you may see that there's a potential conflict of interest there that could be causing problems. So there's a lot of different things that, different kinds of fraud schemes, and they sit in different parts of the business. We also have some tags in here for the AP&E, so accounting, purchasing, and estimating systems. So when we come in and look at the different data systems to build risk models, these are usually the systems where we're going to detect these kinds of fraud. They're not, fully encompassing. There might be some blending between these different systems, but these are usually the places that we're going to be looking. James, if we go to the next slide. Thinking about the different systems and then how analytics are going to build off of all of that. To do analytics, you have to really understand, the in-scope data universe. If we're going to be looking for fraud related to the customers, we aren't going to be using the supplier data. But to, look at specific concerns, we develop an understanding of the in-scope data universe. From there, we're going to build models off of that. And it's going to be, we always think about what is the risks associated with this business? What are the concerns? We're going to tailor it to that. We're going to iterate through the model. We want to make sure that we're accurately identifying risks. And then we're going to ultimately generate a risk rating. So when we develop these risk ratings to actually apply back and review everything, we want to make sure that we're only capturing those pieces of the business that are the most impactful. So we're not going to test. If we're brought in for a potential expense reimbursement concern where someone's submitting fraudulent invoices or they're expensing, personal meals, we're not going to be as focused on testing for someone who's submitting, $7, $8 expense reports because they went and bought a Chick-fil-A sandwich. You're going to be more concerned about trying to identify the large scale issues. So the easy example is they're taking someone out to a 5-star restaurant, but they don't sit in a client-facing role, but they're consistently taking out external parties. These are the kinds of questions that we're asking and developing the appropriate risk profile to capture the biggest damage possible. So, Brian, if you wanted to add anything to that?
Yeah, no, I just say, I think the best part about this risk-based approach is whether it's proactive or reactive. Many times it's a collaborative exercise between us and the company who's typically looking for forensic accounting support. Right, there's always going to be a nuance to every type of business, but I think this is a great example of kind of the fundamental approach that we take to analysis. And I thought you provided some good examples as well.
All right, great. So let's talk a little bit more about the technical side of things. So as we talk about data, most everybody, James, if we go to the next slide, will tend to think about their technical and data side of things as a big rack of servers. Everything's interconnected. We think about spreadsheets, the cloud, or really just a black box where everything happens. But in reality, it's not usually a row of servers all neatly in order. It's usually a little bit more separated than that. People tend to do their own processes. They have their own ways of doing things. It's not usually a fully standardized process. So ultimately, data analytics is the maturity of your data analytics program, or any data analytics program, is a journey. So if we go to the next slide, James. Most companies are moving down this road, some of them faster than others, but it's always important to remember that it does take time to move down the road. There's a lot of different advanced spreadsheeting. Companies have been moving through the SQL Server, data lake, dashboarding stage relatively quickly. But ultimately, there are roadblocks that are starting to really come up once you get past the dashboarding phase. Getting your house in order and understanding what data you have it takes time, and that's what people have been doing over the last decade or so. But in the next phases of getting to adoption and machine learning and predictive analytics, there are some major roadblocks, and the ACFE identified this in the last year, that it's predominantly budgetary, data quality issues, in-house limitations, and lack of perceived ROI. Ultimately, it costs money to build out compliance programs and strong analytics programs for any use. And there's a lot of people that are not looking towards the future with solving these problems or looking internally because it costs money to do it. You have to have specialized people to build out these programs, or you have to bring in a third party to do it. And they're not sure how much they're going to get back from it. So what we're seeing is, the best place to start is always to leverage what you have in place. Whatever tools you have in place, or if you're looking at a company that has analytics tools in place, it's never good to just throw it out and move to the new shiny thing. It makes sense to use what you have and determine if you need to keep moving down the road. Dashboarding may be sufficient for the companies that you're talking to, and other companies may need predictive analytics because they're working with big data. So from there, I'll talk a little bit about the tools that we actually use on a day-to-day basis. So we look at a lot of different kinds of coding languages and database structures. The data forensics team, personally, we use SQL, Python, Excel, Alteryx. So SQL, most people, this is really how they interact with databases. Python is an object-oriented programming language and has machine learning capabilities in a lot of different ways that we can manipulate data, we can analyze it, we can do statistical analysis. We do a lot of work in Excel too. Not every engagement that we come into has extremely clean data. Sometimes it is reports that are tracked in Excel, and we have to manipulate those as needed, or we have to summarize the data as it currently sits. And then Alteryx is a data modeling software where we can we can build out our models over time. We can identify different data sources. We don't have to spin up a database every single time. I will spend a little bit of time on the analysis section of this, but we have a pretty good walkthrough later in the presentation about some of these. So the big data rules-based analytics, this is where we focus on identifying consistent behaviors or risk factors, such as non-unique vendors, or unique vendors, excuse me, consistent payments that are coming in under structured limits. So if you've heard that you can't deposit over $10,000 at the bank because there's a concern, it's because of anti-money laundering concerns. So we look, one thing that we can look for is, do we see people consistently depositing just under a limit like that? Other questions are, do we see round number payments. So somebody's always submitting their expense report for exactly $100, questions like that. Other kinds of analysis that we're doing is the network analysis. So this gives us a nice visualization of, communications or interactions. It's nodes and back and forth communications and processing. So we're able to visualize how money moves around in a network. So this is really powerful when looking at cryptocurrency investigations and understanding, specifically in money laundering, when you're looking to see how money is moving through and how these coins are moving. This is something that's been coming up frequently. Geospatial analysis, this is just a very nice visualization of where and when things are happening. So if you have a company that only operates in the US and you look at geospatially, there's a lot of payments that are getting sent out to foreign addresses. That should raise some red flags. Time series analysis is a great way to look at how a business changes over time. It's also an effective way to look at whether a compliance program is getting kind of the returns that you want. If you see that the business has grown 10 times over and the number of risky transactions has not continued to go up, or you see that the reasons that a company is, that was scoring highly on risk transactions is because they had improper customer documentation. So their KYC was not good. You could see that those numbers of concerns are going down, then proportionally, then that's great. That means that they've been accurately documenting everything. And you can say, we're really making these internal controls work for us. Finally, I'll talk a little bit NLP, natural language processing. This is really helpful and effective when analyzing emails and more unstructured data. So you can see communications, see if somebody's behavior or the way that they're talking has changed. So that might indicate that there might be some financial pressure or some rationalization when it comes to fraud. So if somebody's talking differently and their behaviors with how they do their job, or there's questions being raised, all of these things kind of come back together to indicate maybe something is off here. Ultimately, we report out in a lot of different ways: Power BI, Tableau. There's a good Power BI dashboard we'll walk through here a little bit later. Alerts, so compliance programs helps flag things. Case management is also really good for proactive resolving questions when risky transactions or behaviors are identified. And then traditional reporting, we report out PowerPoint, Excel, Word. When people go in, when our team can serve as expert witnesses, we have to document our methodology. If we create a damage report, we have to explain everything that we've done, and it has to be accurate, repeatable, and ultimately that's where we come from. Next page. So there's really three main categories of analytics that we focus on. Depending on proactive or reactive projects, we're going to be asking different questions. So when we talk about a reactive project, we come in, something has happened. We're going to focus on what happened and why. Ultimately, this means we need to know what happened, where is the data that can tell us that how this happened. It's usually we start from the place where somebody actually identified a problem. Then we'll develop kind of a pattern or a trend to see, is there other behavior like this that's already going on? Because it may be that something looked suspicious, but we come in and we can identify, okay, this is really just how the business works, and there's just a lack of controls, which is an issue in and of itself. And then also ultimately why it happened. So we're going to be looking for those characteristics of fraudulent behavior, identifying the risk metrics, and then coming out and saying, maybe there is potentially fraudulent behavior here, and saying, okay, here's the damage number that we think happened. Now, on proactive engagements, we're going to be focusing on the why it happened and what will happen. So these are instances of what is the behavior that we can think of that's going to look fraudulent in this system or could be fraudulent. And then ultimately, what will happen if we roll out that this is how we want to identify things as being risky. And then how do we set risk thresholds so that way we know what needs to go get tested. So that's really the value of kind of thinking about it in two different ways: what happened and why it happened, or why it happened and what will happen. We want to make sure that every proactive projects, especially, we're building out something that's going to be more future-proof. It's not just going to solve the problem now. If we know new systems are coming in, how do we build the model so that way it can incorporate new data? And then ultimately, not even just from our fraud perspective, but from any perspective, analytics provides a bunch of different benefits, but it's really increased coverage, operational efficiencies, consistency, and governance. And what this means is you know where your data is coming from. It's coming from the same place every time. You know how you're pulling it and how you're evaluating it, and then you know what to go do with it. If you pull your reports every month for revenue because somebody tracks it in an Excel spreadsheet and then they just manually put everything in, what if that person's out on a day, or they miss an email, or they miss an invoice? It's the easiest way to think about it is you know what's going to happen, where you're getting your numbers from, and what you're going to go do with them. All right, and I think from there, Brian's going to walk through financial statement fraud.
Thank you so much, Jacob. Yeah, James, we can go ahead and move on to the next slide. And, with the interest of time, I know we're running up here close to the end of the hour, and we do want to give folks the opportunity to at least ask questions. We'll go through a couple scenarios and examples of financial statement fraud, as well as asset misappropriation here in the coming slides. So really coming back to the fraud tree, right? This is what we were talking about earlier: the three elements of corruption, financial statement fraud, and asset misappropriation. We've got a drill down image on the top right section about what makes up financial statement fraud. And most of this, you can kind of see some commonalities, but I think there's a couple important topics to hit here, right? Overstated revenues, right? This is an issue of the premature recording of future sales, maybe to meet quarterly or annual metrics. This could also be part of a scheme relating to unusual refunds, returns, or other kind of financial adjustments. Fictitious revenues, right? This could be an instance of double counting revenues, fake customers, falsified contracts, or again, some type of unusual returns or refunds, right? So those first two examples that we've talked about, right? This is essentially typically a scheme to overstate revenues, right? To make the financials look rosier than maybe they are in actuality, right? So not only is a fictitious revenue typically going to inflate your revenues, it's also going to inflate your bottom line, your profits and your net incomes, and potentially is management or other individuals compensated based on the performance of the financials, right? So these schemes kind of evolve with each other, right? So an overstated revenue scheme is not solely limited to that being the core problem in itself. It's the next steps, right? So you run analytics or you leverage tools or analytics that maybe identify these types of issues or risks on a financial statements, but then you got to dig into the why, right? So, and that's a piece that Jacob was getting into is, okay, hey, something doesn't seem right about the revenues, but you got to really dig into what are the decisions, what is the documentation to support that, right? So you can't just rely on the numbers themselves. There's a broader story to tell, and that's where we really come in, right? You start pulling contracts, you start looking into customers, confirming the location or the identity of customers, right? These are all different types of analytics and procedures that we would perform to kind of flush out these types of schemes and confirm or refute what could potentially be identified. Timing differences. Timing is a huge piece of your financial statements, really getting back to quarterly and annual, pictures and presentations of the financials, right? So are there maybe period end adjustments that are making the revenues, impacting either the revenues or the expenses, and then in the next period you're seeing those types of adjustments reversed or adjusted, right? Maybe the adjustments were much higher than normal, and that's really, again, the next step in that process is, okay, maybe you leverage data analytics, or maybe in your normal everyday day-to-day job you're seeing something that doesn't seem right in terms of timing, big adjustments. The next step is, again, moving into that. Okay, so what is the support? What is the rationale? What is the reasoning behind these adjustments, right? That's really when you're going to get to the crux of the issue. And so just those are types of things that, forensic accountants or non-forensic accountants can be thinking in their every day-to-day jobs is, okay, I see something, it looks odd, it looks different, it looks out of place, then taking it to the next step and saying, okay, well, what does this mean? Why would somebody do this? And what is the documentation or support around these types of entries? Other ways financial statement fraud occurs, right? Improper asset valuations, typically inflating the value of your assets, carrying a stronger balance sheet than one might have, or concealing liabilities, right? Maybe there's off balance sheet debt or other types of loans that aren't being accurately or fully reflected on the financial statements. And then improper and incomplete disclosures, right? Is there anything that the company is required to disclose at certain periods of time, and it was or was not disclosed as part of maybe the footnotes or other piece of a report? These are all, again, active live examples. Data analytics can get you, whether that's Excel data analytics or whether that's, machine learning predictive that has alerts, right? That the data analytics can get you there. But then there's another step to the process, and that's really where we typically spend a lot of our time, is the what, the why, the how, the rationale behind these certain instances. I'll move on to the next slide. Jacob, I think you were going to walk through some of these different types of analyses. So
Yep.
I'll hand it over to you for a moment.
Yeah, absolutely. And so when looking at like financial statement fraud, these are probably things that these analyses, at least at the top, vertical, ratio, horizontal, and trend analyses, are probably things that you've done before. But I think the difference is how we will move forward with questions that we get raised when we're doing analysis like this. So when looking for, if you are looking at a company and you see that the debt to equity ratio, I'm calling that one out and I've highlighted it here, for a ratio analysis seems off. You might see elevated debt to equity ratio that may concern you about an investment opportunity of, I don't really know if I want to move forward with the investment at this company because it looks like they're really starting to accrue a lot of debt, and I'm just worried, they may not be able to get out from under it, or it's just going to limit potential upside. For us, we think about that, and we might be brought in by someone who's already invested with the company and saying, we are seeing the debt to equity ratio at this company climb, and it's raising concerns about the financial statements. And it might be that because we're starting to accrue debt, and it's creating financial pressure on the management at the company to, returns might need to start increasing, and they're trying to take on debt to finance, growth of the company, make it move quickly. And that's going to open up potential fraud. And so these are the kinds of questions that we might be asking that are a little bit different. When we're also thinking about other kinds of analysis, vertical analysis, do the costs align with company offerings? If a professional services company is showing that they have high cost of goods, that doesn't really align with the fact that most of what you're paying for, or most of the cost of a professional services company, is going to be salaries and things like that. So do these costs make sense? Do margins align with the industry? That's kind of a snapshot in time analysis that we do. We also do horizontal and trend analysis, which are a little bit different. Horizontal analysis is really direct comparisons from reporting period to reporting period, looking for patterns and year-to-year differences that just don't seem to make sense. Do we see a large change in entertainment expenses? As a company moves into a new region, did they spend a bunch of money on entertainment, and then the next year they didn't expand to a new region and there's no entertainment? That just, that can open up issues. And then ultimately, trend analysis, there's something that's called Benford's Law, which is really just the natural sequence that numbers tend to appear 0 through 9. And when analyzing, do we see instances where the same number keeps popping up more than it should be? I think Brian mentioned the accountant earlier. This is something that Ben Affleck did in the movies, going through and he's saying, oh, we're consistently seeing this digit. Every time a fraudulent invoice, this one is here, this one is here. These are the kinds of questions, that we can run statistics and we can run analyses on financial statements to identify things like that.
And the other thing I think I'd add to this real quick before we go on to this slide, right? The luxury we have many times is in a proactive situation. When we're talking about analytics and action, in a proactive situation, we're typically brought in and there's a brainstorming session where, hey, let's build in some KPIs or some metrics that can identify when, these ratios are, essentially, not met, or when certain thresholds, or trends occur, right? That there's an alert or the red flag. We have the luxury where we go through when we brainstorm and we build that out with the company. On the reactive side, we also have the luxury where typically we come in and there's kind of a known set of issues or risks, and we're able to kind of target our analysis on those. I think then if I take a step back and I kind of put myself in the shoes of somebody just every day, I think this is where Jacob said, a lot of these types of analyses, folks are performing in their everyday job, right? And so that's where I think this type of slide, this type of mindset, and these are kind of useful thoughts and considerations. Like, hey, when you're reviewing an investment or an investor or other kind of activity, are you looking at the data in different ways, right? Vertical, ratios, horizontal, and trends. And then do the outputs of those analyses align with what you expect, or are they different? And then the question I think you have to ask yourself is, okay, why are they different? There are many times there are very plausible, reasonable explanations on why a statistic or the output of one of these analysis would shoot out something that looks like an anomaly, but when you dig in the details, it can be reasonably explained. But it's kind of working through that process. Again, if you've got a list of, say, 15 outliers, work through that mental process of what are maybe the most material, what are the most risky to the company, and work through it that way, right? Those are just some thoughts and tips, again, as we talk about the practical use maybe for this audience in their everyday to-day jobs. And then we'll move on. I'm going to go quickly through this last slide, though this is probably the most fun type that we typically run into, right? This is asset misappropriation. These are the common themes that you see very frequently on the news. These involve some of these examples I gave earlier. It could be improper billing schemes, improper payroll schemes, ghost employees, maybe changing folks' bank accounts, or rerouting of bank accounts to your personal. So say an individual left the company, right? Most companies have a process in place where how the final paycheck is distributed, and then essentially closing them in the HR file. Right. Well, if there aren't controls in place for those two mechanisms, you open up the opportunity for the potential to adjust bank accounts and continue paying those individuals on the payroll. False invoices, double billing, duplicate invoices, refund schemes, and then the various improper use of T&E or travel and entertainment. Again, one of the great things about this kind of category is companies typically have processes in place. Most companies have a process and policies in place that provide guides for certain activities across each of these. But I think what's really important is we can the way data analytics can be applied is different elements, right? There's the geography, there's the different expense types, there's the amounts and the timing. And then there's the controls and approvals, all of these elements, and then many more. Data analytics can be leveraged to prevent, identify, and detect these types of activities, or in the reactive space, identify hey, you identified this one issue. When you apply an analytic of that theme to the population, it spits out these other transactions that carry similar characteristics. And so we'll move on quickly. I think we won't go through this slide here. This was a really good example of analytics in action, right? This is kind of bringing everything full circle. On the screen is kind of an example where you have various dashboards or visualizations on weekend. This would have been applied to an underlying data set where you can look at weekend transactions, duplicate payments, right? What are the parameters around duplicate? Maybe that's date, dollar amount, and vendor, and maybe as well as a duplicate invoice. Round dollar payments, overseas payments, right? Payments to customers. Maybe you're focused on payments to customers in a specific state or specific region. This is all kind of an easy visual for someone as they're running analytics. So I'll pause. I think we're at the end of the time. A lot of these next slides, there's only 2 or 3 slides left. It's really, again, from a forensic accounting, kind of questioning mindset. So you identified an outlier, so what, right? What is the so what, right? It's what is the sensitivity? What is the materiality potentially? Who should you notify? And then, one really critical element is, legal privilege, right? Do you need to consider, raising this to internal or external counsel? And I think with that, that's probably where we'll wrap up here today.
Great. Thank you so much, Brian and Jacob. And thanks to everyone who joined us today. Be on the lookout for an events survey, a replay, as well as the presentation to follow. And to stay up to date on everything CFA Atlanta, visit our website and check out the events page. Looking forward to seeing you at the next one.
Thanks, everyone.